The world is getting crazier by the day, but it's nice to be able to chat with someone like you and try and make heads and tails of it.
Gold is already hitting record highs with a strong dollar and with high interest rates. We can imagine what's going to happen when the Fed does flip back to easing.
Great point. We're spending $100,000 every second for stupidity, $1 trillion every 100 days for stupidity. So you just shift your focus from stupidity to gold, and bang, you just buy whatever anyone wants to sell. And that is just to massively devalue the dollar. And you keep hearing both administrations talking about their goal would be to devalue the dollar and keep interest rates low.
Just imagine what happens when people realize they can get a yield on gold as well as they can on their dollar. It's just going to double down on the effect of the gold price going up.
What happens to the stock market and the economy and the cryptocurrency market when all of these whales sell? Bang, gone, and the market just goes whoosh.
Everybody can now hold gold as a reserve currency, and they can hold it in bar and coin format, the type of stuff that Andy's business sells. You can even use it as money in the way that Glint Pay allows you to do.
In a world edging towards economic collapse and societal upheaval,
we're up against a real polycrisis.
Inflation is eating away at our savings.
A shaky banking system is putting our financial security at risk.
Government debt
There's unthinkable record highs.
and the wealth gap keeps growing thanks to an unjust monetary system.
Add in AI,
And advances in longevity disrupting jobs,
a looming property crisis,
geopolitical tensions.
and it's clear we've got our work cut out for us.
Our podcast is here to offer some hope
We're all about navigating these challenges by advocating for sound money principles.
and smart use of tech,
Our goal is to help you take control of your financial future
showcasing resilience, determination,
and practical solutions in these turbulent times. My name is Jason Cozens, founder and CEO of gold currency platform Glint.
and I am Andy Schectman, CEO of gold bullion dealer Miles Franklin. Welcome to the Resilient Compass podcast.
A quick one before we get back to this episode. Just give me 30 seconds of your time. There are two things I want to say. The first one is I want to say a big thank you to the army of you who already work with us as clients and who support our mission. And for those taking the time to tune in and listen to the show today, your support is very important. And secondly, we are just getting started. And if you like what we are doing, please hit the subscribe button and add your comments below. We need to know what matters to you. It is really important to help us grow and spread our mission. Thank you. Now back to the episode.
Hey everybody, my name is Jason Cozens and I'm here with my co-host Andy Schectman. Andy, how are you today?
I'm good, brother. It's good to see you, Jason. It's good to be back, my man. The world is getting crazier by the day, but it's nice to be able to chat with someone like you and try and make heads and tails of it.
Yeah, and sometimes with other people as well. Last week we had Mike Carter on the show, and for those of you who've watched it, we discussed the economic justice movement across 20 US states that are all working towards authorizing transactional gold and silver as currency. That is going to be incredible as we watch that unfold over the next 12 months at the various legislative sessions across the USA. And if you haven't watched the show, please go back and watch it. It was our last show.
What an interesting guy Mike was. I enjoyed that very much.
He's great. And it's great to see, isn't it? People like him, grassroots movements who are giving up their life and dedicating their own money and stuff to try and improve things, isn't it?
These are the people we need to align with, the people, and to me, they represent the American spirit, the people who are advocating for the constituents of each and every one of these states that are allowing people to have an alternative to the irresponsible fiscal policy and the irresponsible monetary policy that has led us into or led us down the path of currency debasement and inflation. And having alternatives that are state sanctioned, state backed are really fantastic. It's something I never thought I would see. And certainly I told Mike he has my great admiration and respect for the whole movement. And as do you, Jason. The whole movement is spectacular. And it's something literally, if you would have told me that we would see, I would have bet you a lot of money saying there's no way the states will ever go for this. But I guess that is the American spirit. That is, I think, things coming full circle. So it was cool to chat with him.
Yeah, and I think I've seen them go from state to state. And one of the first questions that people say is in the various House and Senate committee meetings, it's kind of like, well, what have you got to gain from this?
Right.
Have you
Well,
got
that's
an
kind of what I felt too. And that's the beautiful thing about it. It's not outwardly apparent. This is a guy who's doing the right thing.
Yeah, him,
Sometimes,
Kevin Freeman, Russell at the Economic War Room, and of course all the legislators. And let's hope we can get some of those some legislators on the show too. But it's great as well to see people, not only just more and more people starting to view the videos, Andy, but also comments coming in, which is great to see that interactivity. One of them, there's actually quite a few questions. Are you okay to answer some of these?
Yeah, why not? Let's give it a shot. Hopefully I don't fall on my face.
So the first one was, please explain this statement that was mentioned. The federal government can't afford to go on the gold standard, but the states can.
I don't know who made that statement, but I would simply say to you that I think the federal government can as well. A lot of people think it has to be a one-to-one relationship where gold is valued at one-to-one with each currency unit. In fact, if you look, for example, at the new BRICS proposal, the unit it's called, it's a 40% gold-backed token. You look at the way the Swiss franc used to be gold-backed, it was 40% gold-backed. That 40% gold backing is a tether to fiscal responsibility. The 60% not gold backed is monetary latitude for central bankers to do what they do, expand the money supply, create things, do things that not being 100% or one-to-one backed would enable. I do think that the states certainly have a easier pathway to this, at least in terms of being pragmatic. But I would argue that the government can and ought to strongly consider it. This is like Judy Shelton. If we were to see an administration change during the election, I believe that she would be the head of the Federal Reserve. She is an advocate of the gold standard. She has talked about issuing bonds denominated or backed by gold in order to inspire confidence. And that's really what this is, because the system, Jason, is one that lacks confidence, and it's backed by confidence. It used to be backed by gold. Now it's backed by confidence that has been eroded. And so you need gold, at least some tethering, some backing to inspire confidence in a system that has squandered it. So I think it would be easier for the states, but detrimental for the government to think that they can't. And ultimately, I think they will.
And of course, I think you're right. It's much easier for the states. They don't have $35 trillion worth
Right.
of debt. They don't have huge interest payments. They don't have, not all of them have this massive deficits. And at the moment, the governments need the Fed to step in and buy some of their bonds, etc. So that was an interesting question. The other one was, is the Federal Reserve or the federal government that owns the US gold in Fort Knox?
It's the federal government. The Federal Reserve holds it on behalf of the federal government, and then they're issued gold certificates as collateral or as a statement for the gold that is being held. But the gold does belong to the US Treasury Department. And that was one of the interesting things about talking about a gold revaluation, is that every $4,000 increase in the price of gold adds, based upon the amount of gold we have supposedly held at Fort Knox and the New York Fed, adds $1 trillion free and clear to the Treasury General account. It does belong to the US Treasury.
Yeah, and that was one of the next questions relating to that, was who specifically is going to buy the gold from who at a higher price, and why would they do that, to have it revalued, and would the rest of the world not have to agree to this? This was in relation to a whole section we did on this last week.
Look at what's going on in the Shanghai Gold Exchange. You have silver for the past several months being priced as high as $4 an ounce higher in Shanghai than in London or the US. Who's going to pay for that? Anyone that has the ability to buy it in the West and deliver it in the East. What if they said it's $40 higher or $400 higher? If you took the price of gold right now, which is, call it 25.15, and divided it by 7, which is the geologic ratio. That is the geologic ratio. That's what it's coming out of the ground at. You get $360. So what if all of a sudden China says, we'll pay anyone in the world $360, and that is our price for any time they want to send us their silver? We'll pay $360 an ounce. Isn't that what the price is? The price is what someone is willing to pay for it. That is what the price is. That's what Roosevelt did in 1933 over my shoulder there, where he confiscated gold, which was priced at $20 an ounce. He paid everyone $20.56 or 67 cents, something along those lines, which was a big bonus to those people because back then 67 cents was probably worth $10 today, whatever the number was. But the point of it is that then he devalued the dollar by 40%, making gold increase by 40%. It's happened. It's held in an account called the revaluation account, and it is what someone is willing to pay for it. So if the federal government just made a blanket statement to any sovereign entity that wants to deliver gold to the United States Treasury, that we will pay a $5,000 an ounce for it, that is what the price is. And that's as difficult as it would become in reality. So I think very quickly, not only would it benefit all of the central banks because they're the ones who own it all and have been buying it all, if they didn't want to partake, all they would have to do is sell their gold to the US Treasury for the $5,000 an ounce, because that is the prevailing price, what someone is willing to pay openly.
Yeah, and we've seen that one of the main drivers of the recent this year's price increase has been those central banks doing just that, buying gold at ever increasing prices, whilst investors in the West have actually been selling their gold. Yeah, and the last one is, if the US is broke, how can they just print the money needed to pay the other countries for their gold?
In essence, what they would be doing is devaluing the dollar. And you devalue the dollar, and this is what you are willing to pay for it. I mean, yeah, we're broke, but think about it. I mean, we're spending $100,000 every second for stupidity, $1 trillion every 100 days for stupidity. So you just shift your focus from stupidity to gold, and bang, you just buy whatever anyone wants to sell. Coming up with the money isn't the problem. And in fact, that would be the solution. You use your make-believe money to buy real money, as foolish as that sounds. And any of these solutions, whether people used to say the Fed has two choices, to inflate or default, I've been saying there's a third choice, and that is to find a villain to incentivize the world to move away from the petrodollar, to sign an executive order to go green. We are currently sanctioning 60 countries right now that are all underdeveloped or poor countries to some degree. We're sanctioning all these countries all around the world. That's the rallying cry, the pushing back against the Western hegemony, the coercion, the sanctioning, and to something more cooperative. This is what's bringing everyone into the fold. And when you talk about how it all centers around the potential loss of the petrodollar, which would then create an environment where every country in the world who's had to stockpile dollars for 50 years, creating this synthetic demand for the dollar, ends, and they dump dollars and interest rates spike as that inflation hits our shores. It resets the system. Stocks, bonds, real estate, the banks, and the insurance companies are all inversely correlated to a massive spike in rates. And it was those guys who did it to us, the rallying cry, the victim, the villain. The fourth solution is probably the least painful of all, and that is just to massively devalue the dollar. And you keep hearing both administrations talking about their goal would be to devalue the dollar and keep interest rates low. This is, in essence, what they're doing, but they would do it on a much more aggressive level, massively devalue the dollar and just pay up for the price of gold. And any of the four solutions are going to create pain for the average person. Certainly, revaluing the gold and devaluing the dollar would only benefit the wealthy, really, because they own assets, and their assets would go way up higher. For the low and middle income people, it would only become more difficult, even though our debt situation was mitigated by raising the price of gold high enough to compensate for our large debt burden. Our assets, in essence, offset our debt, but that is a devaluation of the dollar, making everyday expenses much higher. Any way you look at it, in 2008, we should have let the forest fire burn, and we would be on our way to a new system. But with a balance sheet from the Fed that went from 800 billion to 9 trillion, that's all in bond purchases, which suppress the cost of money, which inflates and distorts asset prices. Any way you look at it, there's going to be pain when they do something to get onto a new system. And my guess is that option 4, not inflate, not default, not find a villain, but to revalue the price of gold would be the most palatable and the least painful. But any way you look at it, it's going to create a problem.
Not everyone agrees that it's going to be painful. Of course, last week we had the Kansas City Federal Reserve's annual Jackson Hole Economic Symposium. It's set in an amazing place. These guys know how to throw a party. It's the backdrop of Jackson Hole is that amazing Teton mountain range, but they don't think there's going to be any pain at all. All the central bankers were there. The UK's Andrew Bailey, the governor of the Bank of England, and of course his counterpart in the US, the Fed's Jay Powell. They hit back at fears that growth would need to be sacrificed to reach their inflation goals. As they begin to cut borrowing costs, both men signaled they were still on a course to avoid a recession. And Powell said, the time has come for the Fed to cut interest rates.
Yeah, everything the Fed has told us, going back to Bernanke saying the subprime crisis was contained, or that inflation was okay, fine, it's transitory. Okay, fine, it's structural. Everything they keep telling us is a bunch of malarkey. And one of the things that came out of there that wasn't really reported was a report that was presented at the meeting that basically said there's a shift in investor behavior. And it raises questions about the exorbitant privilege that the US government has long enjoyed to borrow broadly in the global market, even as the federal budget gap grows ever wider. That's the point. If you're a system that's based on confidence and you are, in essence, destroying the value of the dollar through inflation at some point, and then you add into it the weaponization of the treasury market, where if we don't like what you're doing, we're going to confiscate your treasuries and even maybe give it to the country you're in the midst of a war against in the form of weapons. And this is a line that's very difficult to come back from once crossed. We are at 123% debt to GDP. When I was a younger man, 100% debt to GDP would be Banana Republic zone, just like the changing the definition of a recession. Did they change the definition of what is a banana republic? Of course, we would never have issues with our elections or our judicial system like banana republics do. Interesting thought experiment. But the point of it is that this is really the thing that is ignored. And the constant nonsense coming out, jawboning coming out of the Federal Reserve should not be believed. In essence, they haven't proven to us that what they say is credible. And they're always they're behind the curve, they're reactionary, they're not forward thinking, and they're really not overly honest either, at least in terms of the outcome. So to me, this report that was presented there is the most honest thing that I've heard. And that is true. If you think about it, why would anyone want to hold treasuries in a country that is creating $1 trillion every 100 days in debt and not getting any better anytime soon, along with all of the other issues that we face? This is why Judy Shelton said, look, if you want to get people to buy your long duration treasuries, you have to make it redeemable in gold, which is the perfect inflation hedge, rather than trying to pick an inflation gauge. And when you have a country that lies about the information coming out of the BLS, whether it be employment revisions, almost 1 million jobs revised, or the way that they calculate inflation, which continues to be changed. If steak is too expensive, we switch in hamburger. If coffee was too expensive this year, up 80%, we take it out of the CPI, maybe put tea in its place. All of these things that are continually done by the BLS, we should just take the L out of BLS, because the numbers, how can you for a year tell the public, look at how strong the economy is and all these jobs we've created? Look, the very fact that most of the jobs that were created over the last few years were jobs that came back from the pandemic shutdown. Okay, fine. So all these other jobs that you're talking about, most of which are part-time, we're off by 1 million. We're sorry. So every one of these monthly increases that we said, yeah, we hit our target and we're strong, and no, we were lying, and we just had to revise it quietly the following year, and it just gets brushed under the rug. I think at this point right now, we take what's coming out of the Fed with a grain of salt, and I think to do otherwise would be foolish.
Yeah. And of course, their whole, they never mentioned once, there was no mention at all about money printing or monetary tightening in their talks. Everything's about supply chain shocks and things like that. It's absolutely appalling that they never take any responsibility or point to any responsibility around their monetary policies. But of course, actually markets themselves didn't respond particularly buoyantly to this news. The S&P 500 has remained, after a little bit of a blip up, and traced back again, and the S&P 500, the Dow Jones, and the NASDAQ all are relatively flat if you look at it from a monthly view. So markets, they're a little bit reticent. I think there's a lot of concern about what's going to happen with the jobs numbers as they come out. And of course, we've seen, and we've talked about it before, that those job numbers are often manipulated. And suddenly you have big reevaluations after the fact. People are worried about AI and whether that's a bubble. But yeah, they obviously have no idea. They're completely out of touch, I think, about inflation. Cost inflation is now pushing fast food business models to the brink. And we've been able to see from recent data that food was taken away from the restaurant, fast food takeaway. The cost has increased by 30% in the last 5 years, according to the Bureau of Labor Statistics. And takeaway food rose 4.3% year to year over in July. So that doesn't look to me like inflation is being tamed at all. We all feel this in our wallets, even though the stats are saying one thing. What we feel is very different. In fact, McDonald's was recently stung by reports that it was charging $18 for a Big Mac, and the company's president had to issue an open letter back in May. But what's driving this, of course, is that their staff costs are up 40% in the last 5 years. This is huge. And these businesses, they've been really working hard, contrary to what some people would say, food businesses gorging themselves on profits. Contrary to that, their costs are increasing. And of course, they're reluctant to pass this on to the customer. Businesses generally are struggling to pass these rising costs on to customers. So it doesn't look to me from that data that we've got.
Don't be silly, Jason. It's the greedy business owners, don't you know? It's the greedy business owners. And you and I both know the owner of a very large grocery store chain, a very large one. And if you speak with this person about it, she gets very upset. Yeah. This is an industry that if they're lucky, they make 1 or 2%. Yeah. Forget about the fact that we are spending $1 trillion every 100 days, which took 200 years to do it the first time. Forget about all of the mismanagement of monetary and fiscal policy. Let's blame the grocery stores or the CEOs of places like McDonald's. And you're right. I went to the Wynn Casino in Las Vegas, and granted, and I saw you out there, and granted, it's a beautiful hotel, right? It's expensive, but I ordered a cheeseburger up to my room because we had a late dinner with you that night, and I had a talk at 1. And I'm like, I don't want to eat too much. So my wife and I split a cheeseburger. It might have been the best cheeseburger I've ever had, but a cheeseburger, French fries, and a Coke was $74. Now, that may be a poor example. Yeah, the cost of food and the cost of inflation is real no matter what they tell us. And I think that's really important here, is that the goal is to lie about inflation because of the effects it has in managing not only the debt, but the expectations of the Federal Reserve. They're not honest with us about what's going on with inflation. And one other thing I'd like to mention, I know we try to keep in some sort of an orderly time here, but real quick, you had mentioned the market's reaction after the meeting, and it didn't do a whole lot. I want people to understand that the cyclically adjusted price to earnings ratio, otherwise known as the CAPE ratio, a guy named Robert Shiller, I believe, is the one who invented it. You go back to 1880, anytime we've had a CAPE ratio at or above 25, it talks about a market collapse. And you're right at the peak of the mountain before it collapses. You go back and look at every single time this has happened, 1, 2, 3, 4, about 10 times this has happened since the 1880s, and it's always preceded a market collapse. So here we are right now at 30. I'm looking at the graph, about 36 right now, but all seems to be fine. They're massively and historically overvalued, the stock market is. And yet, soft landing, don't worry about it. Everything's going to be great. I think people have to start understanding that what the information we get out of the Bureau of Labor Statistics and also the Federal Reserve open market committee meetings are fluff at best. And I think you have to be your own central bank. You have to to be your own insurance company. You have to start thinking this way. And when you think about gold, which is not something we traditionally view as being an investment, to me, it's wealth. But when you speak of its investment prowess, you go back to 2000, it's averaged 9.9% per year. It's outpaced every traditional asset there is. And here we are at January 1st of 2020, or at 2001, gold was at $252 an ounce. So it's up tenfold. It's up tenfold, and it's done what gold is supposed to do: protect your purchasing power quietly, not sexy, not the hair, not Bitcoin, not Nvidia, not Apple that gets all the glamour, but it's outpaced those, and it's outpaced the tech industry so far this year, up 20% versus like 16. You wouldn't know it if you were John or Jane Q. Public. This is what I mean, is that the what's real and what's relevant is not being told to us by institutions like the Fed or the BLS.
Yeah, and of course, going back to this thing about the data around the markets, we've talked about it before. If gold is already hitting record highs with a strong dollar and with high interest rates, we can imagine what's going to happen when the Fed does flip back to easing.
Great point.
More currency debasement and lower interest rates. What's going to happen to gold then?
Yeah, and what's going to happen to all assets at that point? You're talking stocks and real estate and gold at all-time highs in this environment. When they pivot, you just create greater distortions in those types of assets. But when you look at gold, which is maybe gold and silver being two of the only assets that weren't negatively affected, in other words, all of these other assets were distorted along the way through suppression of interest rates and easy money. Gold and silver were stepped on because of the implications of rising metals, what that means to the game. And when you look at gold and silver, let's just focus on gold for a minute, at performing the way that it has in an interest rate environment that offers a positive real return, a strong dollar, and negative or massive outflows out of the ETFs for the West. In other words, lack of investment participation, strong dollar, positive real yield, and gold keeps on going higher. What happens when the West pivots and starts loosening? Again, yeah, it's rocket fuel to a market that is already outperforming what would conventional wisdom would say is impossible. No way the dollar would ever, or no way gold would ever go up in the face of a strong dollar, positive real yield, and massive outflows out of the Western investments into physical gold. All of these things these illusions are being shattered by reality because the rest of the world sees things much more clearly, perhaps, as do the central banks, than the public here in the West does.
And just imagine what happens when people realize they can get a yield on gold as well as they can on their dollar. It's just going to double down on the effect of the gold price going up. I think we're going to have a Keith Weiner from Monetary Metals on the show in the near future. And of course, he's built a fantastic product which allows you to get a yield on gold. And it always frustrates me when people say to me, oh, the thing is about gold, you can't get a yield on it. So hang on, you don't get a yield on US dollars either. It's only because you put them at risk that you can get a yield on your dollars. Of course, you can get a yield on gold if you decide to put that at risk too. So it's great to see further innovation happening in the marketplace. But let's talk now about last week. Thousands of people, especially in the crypto world, were worried that they might have to pay huge amounts of tax on their crypto, even though they hadn't been sold, as Kamala Harris was announced would be supporting Biden's tax plans, including a 25% wealth tax on unrealized gains. In other words, if you held an asset, it could be a cryptocurrency that you bought at $100 and it suddenly was worth $1,000, you might have to pay tax on it. That's what people were worried about until, of course, they realized, and it was clarified, this is limited to just those people with more than $100 million. And I've got a number of issues with this. I'm sure you've got some comments too, but mine is that we talked about last week the Cantillon effect and how those closest to the money supply benefit disproportionately from those furthest away, and that effectively the wealth divide is being driven it's being driven by monetary policy, i.e. those able to get close to that money printing, they're able to buy assets before they inflate. And this just seems to me that the administration, that they hope to, that they're looking to fix effectively the sticking plaster, the symptoms of the problem. I understand I understand why people look at the wealth divide, the fact that 5 men own more than 50% of the bottom 50% of America, and go, this is plainly wrong. We need to do something about it. But instead of actually looking at the source of the problem, i.e. looking at analyzing the Cantillon effect and the money printing machine, they instead look at problem, the symptom of it, and they say, okay, let's just tax the wealthy and redistribute those tax incomes to everybody who are least well off. The problem that I have with that is that poses potentially as big a moral hazard as giving the wealthy a kind of free lunch in the first place. So I have real concerns about that. And of course, you've got other problems with speculation around assets. Who's going to invest in a speculative look at AI at the moment and the valuations that we're seeing there? Are they a bubble? Are they not a bubble? Would people still continue to invest if they felt they were going to be having to get paid tax on these big unrealized tax gains? It just seems to me that they're playing with fire a bit, although I do understand the sentiment. What are your thoughts, Andy?
Yeah, first of all, on the Cantillon effect, it's a very compelling thought experiment. I think people need to understand that you have to understand and conceptualize how it works, that when money is injected into the system, it could take up to a few years to trickle on down into the economy. A lot of the money that we saw created over the last several years, and it was trillions of dollars, more so than any time in history. The last 4 or 5 years, more money was created in the history of the country preceding it. That money gets, in large part, was thrown into assets by the wealthy. So the wealthy put all this money into assets that inflate. And by the time that money works its way through the system, that inflation, it does so in the form of higher food costs, higher energy costs, and everything. And so the people down at it in the lower and the middle class who are just trying to put food on the table are the most adversely affected. And the people who are able to get it right away, borrow it at next to nothing, and invest it in assets have ridden that inflationary wave higher. When they cash out of these assets and put things into real world economy type of products and services, you begin to see massive inflation. So the Cantillon effect is interesting, and people need to understand that when money is created, it can take up to a few years to work its way through the system. That's why we're seeing it right now. And when we talk about, first of all, 44.6% long-term capital gains rate on those earning over $1 million, it's just absolutely asinine, because everyone who's making over $1 million, who's got a whole bunch of long-term capital gains at 44.6, that's double what it is now. They will sell and sell fast. And you talk about 25% unrealized gains on people making over 100 million, and that's no big deal. That's just the rich. Watch what happens to the stock market and the economy and the cryptocurrency market when all of these whales sell. Bang, gone. And the market just goes, whoosh. What the hell just happened? All of those whales, like you were saying, 5 people that own all. Well, think of all the unrealized gains they're sitting on, the Microsofts and the Apples, and these represent large portions of pensions and people don't think this through. Yeah, get them, they're rich. They don't think this through. What percentage of the Bitcoin whales are held in a concentrated group of wallets from the beginning? What are they going to do? If you owe $500 million in unrealized taxes because you're a billionaire with massive wallet of Bitcoin that you bought in $10 a Bitcoin or less, what you going to do? You're going to sell it to pay for it, and bang, watch what happens to the price of Bitcoin. And the same thing is true. This is so anti-American, it's not even funny. And the bigger one is on $1 million, the capital gains rate. There's a lot of people out there who make $1 million a year who have very big stock portfolios and huge positions in things like Apple and Nvidia and all of these massive gains. And maybe they haven't been wanting to sell. They will if she wins. From November to January, if she were to win, it would be the greatest amount of market turbulence that you could ever imagine as this stuff works its way through.
You're talking about, and of course, if you've got $100 million in assets, you can easily move. You can live anywhere in the world.
You can live on your boat in the Caribbean and say, screw it. And all the jobs and all the benefits that come along with it. So that's why all the people are leaving California and New York and going to Florida and Texas. It's just, it's so
either assets moving offshore or assets being sold in fire sales and causing havoc on the stock market. So, look, I think it's unbelievable how time flies, Andy, when we're talking about these things.
I love our conversations, Jason. You're smart, dude. And I love going back and forth over this stuff. And I hope we're making a difference and continue to do, because these are really crazy times. I really believe that in my soul.
Yeah.
And I think the next 2 months, 3 months will maybe be the most interesting of my life. And that's a Chinese curse. May you live in interesting times. I honestly believe we haven't seen anything yet, and it's just getting started. So this is why you own gold, not to become wealthy, but because it is wealth that has outlived everything the world's ever thrown at it. And here we are 5,000-6,000 years after it was written 700 times or so in the Bible. And the most well-informed traders in the world are buying it like it's going out of style and draining the world's exchanges. One last thing I'd like to say before we go. I wrote this down because I thought it was interesting. Not only has gold surpassed the euro as being, for the first time, the second most held asset or of international global reserves in central bank's balance sheet ever, surpassing the euro. But what we have been seeing also is a huge amount of gold that is being drained from COMEX and the LBMA. So the last thing I want to say is that the gold delivered off the August contract so far is 28% of the registered stockpile. That's a huge amount. The registered stockpile are the bars that back the contracts. 28% of it has already been delivered in August, and that's the highest amount over the last 4.5 years. And we've also seen physical gold being drawn down from your neck of the woods in the London market. In Q2 of this year, an estimated 330 tons or 10.6 million ounces of gold was drawn down from the LBMA. So the big money is using this environment to take delivery. That should be all you need to know. The really sophisticated people who got that kind of bread, they also have the info. And when you're at that level with that kind of money, the playbook, I mean, this is central bank money. This is sovereign wealth fund money. And that to me is more illuminating than anything else, is that the biggest money in the world not only is buying gold copiously, but removing counterparty risk and bringing it home. It speaks a lot to the Western system, to me, because the West has always been the custodian. And if the custodian lacks trust, not only in their currency, but in their safeguard, then the whole thing comes under question. So I don't think there's ever been a better time to buy gold ever than right now. And I say that with 100% honesty and sincerity. And I think what we see happening around us is bearing that to be truthful.
Yeah, I nearly forgot we needed to talk about that. The fact that now gold is, if you look at the reserves that central banks around the world are holding, they've traditionally held US dollars, French franc, the euro, since the French franc, euro, yen, and sterling, and some gold. But for the first time ever, they're holding more gold than they are euros. That's quite extraordinary.
Huge.
This is massive. This is massive. Central banks are holding the second most common currency they're holding their reserves is now gold, more than they are holding the euro. I think goes back to your point, Andy. You can be your own central bank. Everybody can now hold gold as a reserve currency, and they can hold it in bar and coin format, the type of stuff that Andy's business sells. You can even use it as money in the way that Glint Pay allows you to do. But just on that show, we got to bring the show to an end now, Andy.
Yeah, but that's why I'm so excited to have this relationship, Jason, because it's a hand in glove.
Yeah.
Physical and transaction ability is huge. So I know we got to put this to an end, but yeah, I think I look very forward to picking up where we left off, man, because these are important times and important to get some honesty out into the hands of the public, and hopefully they make the right decisions. So thank you for letting me be a part of this.
No,
it's
thank you.
A joy, and I look forward to picking up where we left off next week.
I love working with you, Andy. You really inspire me, and you keep me on my toes. And if people want to buy gold bars and coins, they can do at Mars Franklin. Do you want to tell me about your website?
Absolutely. The best way to reach out to us would be to say that they heard us on this show. Send us an email at info@milesfranklin. We keep our price list, which will be as good or better than anywhere in North America. We keep it close to the vest. Send us an email at info@milesfranklin that you heard about us here with any questions that you heard here. or even questions about Glint, and we will get back to you and answer those questions or send you our price list. If you want to be contacted, send us your phone number as well, and no obligation for the price list. And you'll see it's as good or better than anyone in the country.
Great. And if you're interested in putting yourself on your own personal gold standard with Glint, I'm sure they'll be happy for more customers. You just download the Glint app, the Glint Pay app from your favorite app store, or go and visit glintpay.com if you're interested more. But listen, it's been fantastic to see the comments coming through. We want more comments. Let's get engaged with each other on the YouTube channel comment section. Please share. If you want Andy and I to keep doing this, please share. That's really important that more and more people find out about the show. Do that. And then also we'll be announcing, I'll be telling you about the email address for Resilient Compass next week. I know there's some people are expecting to get some books that we promised. I think last show was the Mandibles. Of course, I've got no way of getting your address off you, but we'll be sending that email address out to people next week. So thank you very much for listening. Until next time, goodbye.